Welcome to my whiteboard, tax students in finance. So I ended off the last video saying that I was going to talk about the 12-month rolling window for including your medical expenses in your tax return. And so that's what we're going to do right now. So I created this Excel spreadsheet just to illustrate how that works. So if we're, as you might recall, our medical expense amount is reduced by 3% of our net income, or a prescribed amount, which changes every year. And we're just going to, for this problem that we're going to be taking a look at, just keep these the same. I mean, I know the prescribed amount for 2018 is different than 2019, but just for comparative purposes, I'm going to keep that the same. So the prescribed amount's 2,352 in 2019. And we'll just keep that. So what does that mean? That means that if we have a net income of 78,400, then or more, then our prescribed deduction is going to be $2,352. So it doesn't matter what I put in here for net income after the deduction from our medical expenses is going to be 2,352, and that's the amount that we can use. So I've got medical expenses for 2018 example. So I put these in, put these numbers in for each month, and at the end of the year, I end up with $2,350 of medical expenses. Well, guess what? If this amount is less than $2,352, so that means that I can't use this. I'm not going to have any medical expense amount to put in my tax return, because 2,352 minus 2,350 minus 2,352 equals 0. So it won't reduce my taxes at all. So I'm sad. This makes me sad. But then I go to 2000. Let's take a look. Let's just analyze these numbers too. So it kind of looks like, you know, business as usual. Maybe I got a cold and I needed some prescriptions here. But then it looks like my medical expenses are really starting to ramp up. So September 100, October 350, November 500, December 800. And then January 1,000, February 400. So it kind of looks like I got sick here, and my medical expenses are climbing every month, but then they start to taper off, and then I get better. Okay, but I have this kind of arbitrary year end in December where it cuts off, and it's really not indicative of reality, of my reality. I had medical expenses from September 2018 to April 2019, and then those medical expenses are cut in half because of a tax year end. And I can't claim any of these expenses. That's not nice. So what the legislators have done to be merciful is say, well, you can use any 12-month window that ends in the tax year that you're calculating your taxes for. So I can start here, just watch the screen light up. I can say that I want to include January and all 11 months back to February. That equals 12 months. So 1 plus 11 equals 12. Or I can include January and February of 2019, and then the other, and then 10 months here. So that equals 12 months as well. And see, these numbers are higher numbers than basically my 2019 12-month number. Okay, so all of my 2019 medical expenses add up to 2,525, but in 2019 I can use a bigger number that includes past medical expenses that were incurred in 2018. So that's a better deal than just using the calendar year end. So what's the best 12-month rolling window? The best 12-month rolling window here looks like it's 3,000 $825. So I'm going to go, let's take this formula here. Oops, it's not going to work. Sorry, guys. So we're going to use we're going to subtract our prescribed amount. Okay, then we're going to be left off with what we can use as a medical tax credit amount. I got to add that. So it's a negative. And then 15% is the tax credit rate. So times 15%. It's $220.95. Okay, so let's compare if we were going to use just add up the expenses for 2019. They equal $2,525 minus our prescribed amount. We're left with $173 medical expenses times 15% equals $25.95. So as you can see, it's way more advantageous to use the 12-month rolling window. Now I want to take a look at, let's just clear these amounts. I'll just clear this. And we'll take a look at the actual demonstration question that I gave you the solution to. So I'm going to just clear these out. I'll push this over and over the question. Okay, so in this question here, we have Frankfurter has a net income of $30,000 for 2018 and $35,000 for 2019. His wife has no income in these years. He incurs the following medical expenses for himself, his wife, and his 3 dependent children. All 3 children are under 18. He has receipts for all these years. So we got 2018, nothing prior to August. So what we're going to do is go over to August. And we're going to put some amounts in. So we're going to go 325, August, September, we got 200, then October, nothing, November, 65, and then December, 125. Okay, so for a total of $715 of medical expenses. Then I'm going to go to January. I've got 225, and I've got 340 in February, March 1500, and nothing April, nothing May, nothing June, July 400, and then after that, nothing. Okay, so let's take a look at let's take a look at this. How does this look? Well, if I've got $715 of medical receipts, we don't really know if we can use those yet because we have to plug in our net income into our tax return and do the lesser of 3% as a deduction or the prescribed amount. So our spouse is Frank, or spouse, one name, Frankfurter. I don't like that his wife doesn't have a name, so I'm going to call her Queen of Canada. Now she's important because she's the Queen of Canada, and who wants to just be called spouse? Queen of Canada. There we go. That's a good name. I like that name. Okay. Oh, yeah. Clear out some things from an old question. So I'm going to put the total income in here is 30,000 for the first year, and 0 for her. And I'm going to link the medical expenses. And as we can see here, when I go medical expenses equals 715, 3% of net income is 900. So I get allowable medical expenses of negative 185. I don't like that. I'm going to put if this formula is less than 0, then 0. Otherwise, we'll do the formula. Okay, so it doesn't reduce our taxes. And what this illustrates is that it's a waste of a tax credit. Okay, it's sad. It's a taxes or wasted credits. Basically, is you know, it's wasted. Couldn't use it. Didn't use it. So that's the scenario for 2018. Can't use it. Now let's go back to 2019. What if we just use the calendar year and we didn't use the rolling average? So we would be able to put 2,465 in for tax credits. We're going to change our total income to 35,000. Okay, we'll go down here and you'll see that the 3% of net income changed to 1,050, and I'm going to change this medical expense amount to the 2019 amount. Okay, so now we finally get a reduction in our taxes of $212.25, and we're left with taxes owing of $5,037.75. But before the medical expense tax credit, we would have to pay $5,250. So this in 2019 we get to use the tax credits, but let's say let's take a look. There's a better option here, okay? And the better option would be a 12-month rolling window. So we can just go along here. So we can use 11 months from 2018, 1 month from 2019. Just keep going along here. Like I'll just light this screen up here so you can see. Keeps getting better as we go along. That's because the medical expenses are more at the end of the year until we finally get to July, which includes all of August, so August to December, and all of January, February, January to July, basically. So 3,180. So let's put that amount in here. And now our taxes are reduced by $319.50. Okay, bringing our taxes down to $4,930.50. Okay, so I didn't put any tax credit amounts in here for Frank Furter. And, you know, he would at least get the basic amount, which is $12,600. Actually, he'd get that and the spousal amount. So he'd get 12,600 times 2 because they're the same amount. So what would his taxes be after that? So we put a couple of tax credits in there, and now his taxes are down to 1,150. Okay. So there you go. That is how the rolling 12-month window works, and combined with, you know, taking a look at the lower income spouse as well. In this example, so I gave a much more complicated demonstration in the last video. I I had the lower income spouse before actually earning some money, and then I played with tax credits, and I had to put in an astronomical amount of tax credit amounts to get my lower, to make it so that the higher income, it would have made more sense for the higher income spouse to use the medical tax credit than the lower income spouse. So if the lower income, it's only when the lower income spouse has a lot of tax credit amounts, probably there are very few scenarios where that would happen, but it can happen. So hopefully you enjoyed this video, and we'll see you in the Zoom meeting happening very shortly. Thank you. Bye-bye.